Welcome to week 7 of our Finance 301 class. This week we are going to be looking at bonds. Specifically, we will be looking at chapter 12 and chapter 13 of our textbook. You probably don't think about investing in bonds since stocks receive more publicity. However, this is unfortunate because bonds offer you interest income, safety of principal, and potential diversification. While there's no requirement that bonds be part of your portfolio, you should certainly consider including them. And so with that, let's begin looking at Chapter 12, the features of long-term debt bonds. All bond, that is long-term debt instruments, share a number of characteristics. They are liabilities of their issuers for a specific amount called principal. Virtually all debt has a maturity date, and it must be paid off by a specified date. If maturity occurs after a year, it is long-term debt. When this debt is issued, the length of time to maturity can range from a few years to 20 or 30 years. In fact, our textbook points out that Coca-Cola has a bond that is outstanding that doesn't mature until 2093. Bond yield, bond characteristics. So a bond yield, you have current yield, which is interest divided by the current price of the bond. And then you have yield to maturity, which is the return earned from holding the bond until it matures. Each debt agreement has terms to the debtor that the debtor must meet, and these are stated in a legal document called the indenture. One of the most frequent requirements is the pledging of collateral that the borrower must put up to secure the loan. If the borrower defaults on a loan, in other words, the borrower fails to pay the interest or fails to meet the other terms of the indenture, the creditor may seize the collateral and sell it to recoup the principal. Other examples of common loan restrictions are limits on dividend payments, limits on the issue of additional debt, and the requirement to periodically retire a proportion of the debt. Default is not just the failure to pay the interest. Failure to meet any of the indenture provisions places the loan in default, even though the interest is still being paid. Many debt instruments are purchased by investors who may be unaware of the terms of the indenture. Even if they are aware of the terms, the investors may be too geographically dispersed to take concerted action in case of default. To protect their interest, a trustee is appointed for each publicly held bond issue. A trustee is a representative of rights of bondholders that enforces the terms of the indenture. Risk of default on interest and principal payments varies with different types of debt. To aid potential buyers of debt instruments, credit ratings services have developed. Some of these can be Moody's, Standard & Poor's, and Fitch are the three largest. These services rate the degree of risk of a debt instrument. As we're going to see in Exhibit 12.1 here in a minute, we will look at some of the bond ratings. So credit ratings is a classification scheme designed to indicate the risks associated with a particular debt instrument. Investment grade BBB or better, non-investment grade high yield bonds, and poor quality increases the yields over investment grade bonds. So again, here is Exhibit 12.1 bond ratings. So Moody's bond ratings, you have AAA bonds which are of the highest quality, And they go all the way down to C, which is bonds with little probability of any investment value, and that's the lowest rating. Standard & Poor's has AAA, and again, that's the highest quality, and it goes down to D, which are bonds in default. What are the risks associated with investing in bonds? The risks associated with investing in bonds include default on interest and principal repayment, increased interest rates that can decrease the current market value of the bond, and loss of purchasing power through inflation. So now we move to section 12.2, types of corporate bonds. Corporations issue a variety of bonds. These include mortgage bonds, equipment trust certificates, debentures, subordinated debentures, income bonds, convertible bonds, variable interest rate bonds, and zero coupon bonds. Each type of bond has characteristics that differentiate it from the others. You need to be aware of the differences, for some types of bonds are decidedly more risky than others. Mortgage bonds. These are bonds that are issued to purchase specified real estate assets, and the acquired assets serve as collateral. Assets used to secure a loan or debt instrument. And so, while the pledging of property may decrease the risk of loss, lenders are rarely interested in taking possession and operating the property. So, for example, if a school defaults on interest on the mortgage payments for its dormitories, what can the creditors do with the buildings if they take possession of them? While the pledging of the assets increases the safety of the principal, the lenders prefer prompt payment of interest and principal. Serial bonds. These are issued by transportation companies that are secured by the equipment purchased with the proceeds of the loan. These are also called equipment trust certificates. These certificates are primarily issued by railroads, for example CSX, and airlines such as Delta, to finance rolling stock and airplanes. And this equipment is the collateral. And so the collateral is considered to be of excellent quality, for unlike fixed assets, this equipment can be readily moved and sold to other railroads and airlines should the firm default on their certificates. Then debentures. These are bonds with a lower subordinate claim on the firm's assets than the claims of other debt instruments. This type of debt is more risky, for in case of default or bankruptcy, the secured debt is redeemed before the debentures. Our next type of corporate bond is income bonds. These require the interest be paid only if the firm earns it. If the firm is unable to cover its expenses, it is not legally obligated to pay the interest on these bonds. These are among the riskiest of all types of corporate bonds and are rarely issued. Revenue bonds. These are bonds that are supported by the assets the bonds financed. It's income bonds issued by state and local governments. And then convertible bonds. Convertible bonds are a hybrid type of security. Technically, they are debt. The bonds pay interest that is a fixed obligation of the firm, and the bonds have a maturity date. But These bonds have a special feature. They may be converted into a specified number of shares of common stock. This type of bond offers the investor the advantages of both debt and equity. Convertible bonds often pay a slightly lower interest rate than otherwise identical non-convertible bonds, since investors receive the added benefit of participating in an increase in the value of the company's stock. The convertible bond also offers the firm several advantages. First, if the firm gives investors the conversion feature, it is able to issue the bond with a lower rate of interest. Second, the conversion price is set above the market price of the stock when the bond is issued. Variable interest rate bonds. Most bonds make periodic equal payments, but bonds with variable coupons have become a popular alternative to the traditional bond with a fixed coupon. These variable interest rate bonds make payments that vary with the changes in the rate of inflation or changes in interest rates. Zero coupon bonds. While the majority of bonds periodically pay interest, bonds exist that pay no interest. These are called zero coupon bonds. They sell for a discount from face value and the interest accrues, and at maturity the investor receives the bond's face value. One tax feature, however, reduces the attractiveness of zero coupon bonds. The IRS taxes the accrued interest as if it were received. So you must pay federal income tax on the earned interest even though you receive the funds only when the bond matures. Thus, zero coupon bonds are of little interest to investors except as part of a tax-deferred pension plan because the tax on the accrued interest in the account is deferred until the funds are withdrawn. And then high yield securities, or what we also call junk bonds. These are poor quality debt with high yields and high probability of default. Junk bonds are usually debentures and may be subordinated to the firm's other debt obligations. Junk bonds are bought by financial institutions and individuals who are accustomed to investing in poor quality bonds and that are willing to accept the larger risk in the hopes of earning higher yields. Foreign bonds. These are bonds that are sold abroad, denominated in the local currency of the country, sold abroad denominated in U.S. dollars. These are called Yankee bonds, which are bonds issued in the United States by a foreign company and denominated in the U.S. dollars. And then the Euro bond, bonds sold in a foreign country, denominated in the currency of the issuing firm. Foreign bonds fall into two basic types depending on the currency in which they are denominated. U.S. companies can sell bonds denominated in the local currency. For example, they can sell a bond that is denominated in British pounds, or the firm can sell bonds abroad that are denominated in the U.S. dollars. Vice versa, non-U.S. firms can sell bonds that are denominated in their local currency or a foreign currency. If these bonds are issued in the United States by a foreign company and denominated in U.S. dollars, they are referred to as Yankee bonds. A Euro bond is sold outside the country of issue but denominated in the currency of the issuing company. Such bonds can be denominated in pounds or yen, so the term is not limited to European currencies. If IBM sells Euro bonds in Europe, it promises to make payments in dollars and avoids the risk associated with changes in the exchange rates. U.S. investors who purchase these bonds also do not have to convert the payments from the local currency into dollars and thereby also avoid currency risk. However, there is an essential reality. When investors and currencies cross international borders, someone must bear the risk associated with fluctuations in exchange rates. Registered and book entry bonds. Bonds are issued in either registered or book entry form, computer entries. Registered bonds are ceasing to exist because the current trend is to issue bonds as book entries. A record of owners is maintained by the issuer or the bank that acts as the transfer and paying agent. Retiring debt. Debt must be ultimately repaid. This often occurs before the maturity date. When the bond is issued, a method for periodic retirement is usually specified. For very few debt issues are retired in one lump payment at the final maturity date. Instead, part of the issue is systematically retired each year. This systematic retirement may be achieved by issuing the bond in series or by having a sinking fund. In addition, dramatic changes in interest rates may cause a corporation to retire bonds before maturity by repurchasing or calling the debt. So serial bonds. In the issue of serial bonds, a portion of the bonds mature in each of several years. So debt issued in a series so that some of the bonds periodically mature instead of all coming due at once. Sinking funds. Sinking funds are generally employed to ease the retirement of bonds. It's a series of periodic payments that retire a bond issue. The periodic contributions to the sinking fund plus the accumulated interest are used to retire the debt when it matures. And then repurchasing debt. If interest rates have risen and bond prices have declined, a firm may retire debt by repurchasing it. The purchases may be made from time to time, and sellers of the bonds need not know that the company is purchasing and retiring the bonds. Unlike a sinking fund requirement which management must meet, repurchasing the debt is a voluntary act. The lower the price of the debt, the greater potential benefit from the purchase. But the firm's management must determine if it is the best use of the firm's scarce resource, cash. And then call feature, or calling the debt. Some bonds have a call feature which permits the issuer to redeem the bond prior to maturity. If interest rates fall after a bond has been issued, it may be advantageous for the company to issue a new bond at the lower interest rates. The proceeds then can be used to retire the older bond with the higher interest rates. The company calls the older bond and retires it. Exhibit 12.2 gives us the example of a security bond, or an example of a serial bond. Government securities. Corporations are not the only issuers of debt. Federal, state, and local governments issue a variety of debt instruments to obtain the funds of individuals, firms, and other governments with funds to invest. Federal government issues securities that range from short-term treasury bills to long-term treasury bills. The emphasis is on short to intermediate term financing primarily because interest rates on short-term debt are usually less than on long-term debt. And one thing to remember is treasury bills are quoted in the terms of yields. Municipal bonds. State and local governments also issue a variety of debt instruments to finance capital expenditures such as schools or roads. The government then retires the debt as the facilities are utilized and funds are raised through taxes such as property taxes or through revenues that are generated by the facilities such as tolls that can be collected on the New Jersey Turnpike or in Chicago or in Florida. The primary factor that differentiates state and local government securities from other forms of debt is the tax advantage they offer investors. The interest earned on state and municipal debt is exempt from federal income taxation. Although state and local governments may tax the interest, the federal government does not. There is little that you can do to reduce the risks associated with inflation and fluctuations in interest rates, but you may be able to reduce the impact of the risk of default. First, acquire a well-diversified portfolio of tax-exempt bonds that spreads the risk over many state and local governments. Second, limit purchases to bonds with high credit ratings such as triple or double A. Third, acquire bonds that are insured. Why would you invest in bonds? Bonds offer interest income, safety of principal, and potential diversification. This concludes our discussion on Chapter 12, the features of long-term debt bonds. Make sure you read Chapter 12. Make sure you read Chapter 13. Make sure that you listen to the lecture on PowerPoint lecture on Chapter 13. Watch any of the additional videos that I post. Also, remember to make sure you do your discussion board post and make sure that you have checked that any other assignments that are coming due this week are completed and done on time as well. Thank you, and as always, I hope each of you has a blessed week.